Are you addicted to it's a scam online content? Do you find yourself constantly on the internet searching for the next online scam that somebody's going to expose or put under a microscope, and you use that to get entertainment? However, over the past year to 2 years, nothing about your life has improved, has changed, especially in the financial space. If you continue to watch this video, I can kind of show you how you can flip always looking for the next scam as a form of entertainment, and you could turn it into learning how to find scams in the market and learn how to monetize or generate profit for yourself and your group by being able to identify those scams and understanding what direction those particular scams are going to go into. What you're looking at on this particular screen is a screenshot of options plays I made on a particular company called Carvana. You see a 76% return on one leverage play. It's a derivative play. On the other play, you see 321%. I still have more plays on this particular scam. I've identified it. To me, this is a pump and dump scheme. And my goal is probably to pull this year around 30,000 out of this particular series of trades. And if you look at the original trade, just because of issues of capitalization, I wasn't able to make this trade as big as possible. Knowing what I know now, with my experience and understanding, I probably should have put $10,000, $20,000 into this play. And if I would have had the money, I would have done. I was confident enough to put $100,000 into this particular play. And this was when Carvana was trading at around $240. And these are puts that I bought in December going out till March of the next year. And this is what I want to try to get you to show. But you have to decide that I'm tired of watching scams on the internet as a form of entertainment. And I want to go back to watching things on the internet as a way to figure out how to generate profit for myself and my group. So we're going to go ahead and break down this Carvana play. I'm going to show you some of the things that I was looking at. And then you can decide whether or not this is something that you're interested in. This is a skill set that you want to learn, that you want to develop. Because my ability to learn and develop this skill has allowed me to figure out how to take opportunities and turn those into money and turn those into profit and turn those into income streams, as opposed to just hearing about it, being entertained by a person picking everything wrong with it. And then after that, I just go into the next situation, but I don't really benefit from it. And so we're going to go ahead and get into that. So what we're looking at is a company called Carvana. They're a used car dealer. And it was because I was looking at really a company called, I think it was Avis, is how I stumbled onto this particular play. So I wasn't looking for it. I was really looking at Avis, and me looking at Avis and looking at the used car industry is how I stumbled into Carvana. Now, nobody was talking about Carvana. None of the people that are talking about scams on the internet, none of the people that talk about, this person getting caught up for doing this illegally, none of them were talking about this particular play. And one of the reasons that their audience has to understand, one, the markets, they got to understand how to look at companies. They got to understand things of that nature. So it wasn't like a good entertainment piece. When you're thinking about, let me give the audience what they want to hear, this probably wouldn't fit under that category, because you actually got to understand how to look at a company, how it's composed, its business model, things of that nature. You can't just identify a person, right? Even though there are people involved in these plays. But what I'm going to show you is some of the things I was looking at. We're going to make this relatively quick. But what you're looking at on those particular early screenshots, you're looking at almost, I would say almost $20,000 worth of profit after we take the initial investment out. If you're going to make $20,000, let's say in 6 months, right? Outside of what you normally do on a day-to-day basis, but even at what you normally do, how much time are you willing to put in to learn the skills to do it, right? And so that's the kind of questions you want to ask yourself. Because the same way those two plays could have been 20,000, they could have been 120,000, because it really was just dependent upon the amount of capital put in on the front end. The downside of the market helped me a lot in this particular situation. But in my opinion, this company was going to sell off even without the macroeconomic situation because of the way it's structured. We're going to go ahead and go into it. So right now we're looking at a screenshot of Carvana, right? This is its chart over pretty much the past 2 years. And so we see it going up to the $300 mark, really $350, and then selling down off of that. And what you got to understand, if you were paying attention, is during this time it was moving up, the insiders were selling out of the play. So the CEO, his father, a lot of insiders was selling their shares back to the market while this thing was moving up, right? Because that was the best time for them to take profit. And one of the things I try to get a lot of people to understand is that most companies don't IPO for you. They IPO for the insiders. An IPO process is a way for the insiders to become liquid. They need liquidity through the public markets. So let me give an example. If I buy into company XYZ and I'm able to get in as an insider early, and I'm able to buy 30,000 shares or 50,000 shares for $1 a share. So I paid $30,000 to get in. The company IPOs, or so let me roll that back a little bit. During the 10-year run up to the IPO, the company valuation starts to multiply. So my equity position at one time was 30,000. It is now 30 million. The problem now I have is if I don't go through the public markets, I have to find a private person or an individual, a group of private individuals that have the liquidity to get me out of my position. That can be difficult because I got to find people that now have $30 million because I want to get out of my position now. But if I can go to the public markets, I can now get out of my position via the public markets, because one thing the public markets do is they allow me to get access to scale. I have literally billions of dollars of capital that I can get access to via the public markets. Often when you see an IPO, it's a liquidity event. It's an exit event. But retail is conditioned to think this is my opportunity to get in. But you got to understand is that these people are utilizing the public markets for liquidity. This whole market is based on liquidity. And I don't want to sidetrack this particular discussion to get people to understand that. So when the liquidity got offered to Carvana insiders, what they did was they sold on the way up. So as other people buying into it, they are selling. Why? Because this is my exit event. This is the reason why I went down this road anyway, was to get a return on my capital and then use the public markets and use this particular scenario that we were in, which really was the pandemic, to exit. Right? Now, it doesn't mean that anytime insiders are selling, that means it's detrimental to the company. Sometimes stock sales are based on what your accountant is telling you. You got to sell for tax obligations. You got certain times that you plan on selling. But we saw in these scenarios was we saw selling to me that was a little bit over the top. And it was because this share price wasn't sustainable, but it was very obscene. So this was the best time to change positions with people in the particular market, right? So that's the first thing that you want to understand. And why was the share price going up so high? A lot of it had to do with the fact that we were in a particular environment to where there was a lot of liquidity in the overall market. And as a result, share prices started to go up because people were buying cars at prices they probably normally wouldn't buy at, but the liquidity actually existed. Next slide. You got to understand the structure of the business. Where a lot of people struggle in trying to identify these plays, and something that I've been very good at, is understanding the structure of the actual business, right? And I think that's where a lot of people struggle. So when they're looking at a business, they don't know how the business actually makes money. And it's documented how they actually make money. So what they tell you how they make money is not relevant to the documentation. And when you look at a company like Carvana, it's really part of a family of businesses based around used cars. And so you got an original business called Drive Time. Really, you got an original business called Ugly Duckling, which turned into Drive Time, which then also turned into Carvana / Drive Time. And then you added another company called Bridgecrest, which provides the financing. So what a lot of people are confused is that when they're going to a car dealership or they're going to a used car dealer, they think the business is selling cars. The business may be getting financing for people that want to buy cars. But when you don't understand the securitization market, you think, well, their business is selling me a car, but maybe their business is selling you a loan. And we use the car to get you into the loan. So if my business is really selling you a loan and I use the car to get you into the loan, my business model is really different than an independent used car dealer that goes to auto auction. And then he tries to buy the car at auto auction at a lower price than what he will sell it to a particular buyer. That's a different business model. He may not have the financing opportunities that somebody like Carvana may provide, because why? he doesn't have the financing arm attached to his business. So where a lot of people struggle is that they can't see the business model. Therefore, because they can't see the business model, they may have to buy into mythology about what the business model actually is. And I didn't have that issue, because one of the things that I've been fortunate with in this market is I'm fortunate to actually see the business model, right? And it's in documentation. So I don't have to make it up. I don't have to guess. I don't have to figure out what people on YouTube want to hear. It's actually in their documents. So when I want to understand how they actually make money, I just go and look at their documents, and their documents will explain to you that's how they actually make money in the market. So that's something that a lot of people are missing out on, right? Let's go to the next slide. So one of the reasons why the share price went up is because used car prices went really, really high during the pandemic. And so that's what got me, brought my attention to Avis, because Avis historically before the pandemic was trading at around $50. And I want to say it just kept going up, and it kept going up, and it kept going up. And I couldn't figure out why. It's because there was a shortage on cars overall, which meant there was a shortage on used cars, but people kept buying the cars. Then it got to a point where people saying, well, it's not a good idea to buy cars, but because there was so much liquidity in the economy and there was a shortage on cars and people still wanted cars, if they could get financing, they would still buy cars. So even though used cars had gone up 26%, there still was a market for cars, right? Another slide. Some used car vehicles now cost more than the original sticker price. So what we call is that the used car game had begotten, really the car game had begotten so robust. Used cars now were going higher than what new cars are going for, because the car market was just obscene. But as long as people could get financing, they didn't care. So a company like Carvana, which fundamentally is not a good operating company, we're going to kind of show you some evidence of that. Their share price kept going up because people were optimistic about the used car market, but they were optimistic about it because of a situation. We know the pandemic wasn't going to last forever. We know the regulations around the pandemic were not going to last forever. We know the supply chain issues are not going to last forever. Therefore, if we believe that the overwhelming justification or the overwhelming reason why the share price of this particular company is going up is because of how people are responding to the pandemic, and we know that the pandemic is not going to last forever, then what is going to continue to support this particular price once we're no longer in this particular environment? So then why would I buy at 350? Why would I buy at 300? Because if I'm buying at 300 or 350, I have to believe that the price is going to be greater than that 5 years down the road. So what would justify the price being 500 in 5 years? And then if I can't come with that answer, then why am I buying at that particular price? But they were able to get people to exchange places with them at these extremely, to me, inflated prices. Let's go to the next slide. So we also get people that are quote unquote insiders or experts in this particular space, and they were also buying into Carvana. And what I want you to understand, and we're going to kind of talk about this later, this is a very sophisticated operation, right? This is not done by people that aren't savvy. And we're going to talk about that. This type of scheme, the way it's constructed, is very sophisticated. And really big cons are constructed very well. They're very intricate in their construction. So that's why the average person can't wrap their head around it, because they can't see the pieces, right? And they use a lot of different things to get people to buy into it. And they do bring in people that you would think would know better. And so because the people that you would think would know better are in these deals, the average person thinks, well, it got to be a good deal, because the people that I've been programmed to think in society would know better, they're also in these deals. So you saw the same thing with, what's the guy's name that ran the big SEC scam with the investors? Well, first, he had position in the SEC. So he had all the credentials, he had all the accreditations. Then he attracted money from people that were also very wealthy. And you would think those people would have the team around them to see the fact that this was a scam. But they couldn't, because the way these large things work is they're able to convince people that you think would know better. And then what the average person does, and they say, well, if this accredited investor says it's a good investment, it must be a good investment, because the accredited investor, the guy that's accredited in quotations, thinks it's a good investment. Well, it must be a good investment. So we can fool those people we definitely can fool retail. Let's go to the next slide. So the narrative, used car prices are up, therefore Carvana is a good investment. That was the narrative. But used car prices are up because of a situation that's happening on a world level that's not going to last forever, right? And it's really that it's not going to last forever. It's still going on, but our perception of it is going to change over time. The pandemic hasn't gone anywhere, but our perception of it and how we should respond to it wasn't going to last forever, right? So because those conditions were not going to last forever, we knew the prices could no longer support themselves over time. You weren't going to be paying 26% higher for a used car year over year over year over year. It's not sustainable. Let's go to the next one. How do we sell these type of ideas to people, right? So how do we sell this idea that we have something different and it justifies these share prices, even though our business structure is really that our goal is to sell you a loan using a car. It's really all it is. It's a very simple business. I sell you a loan using a car. The dispenser that you see off the highway, they got a real nice one in Atlanta. I haven't seen the one out here in Houston. They got one in Orlando too. That used to be close to my house. The website, all of that, they got nothing to do with their business model. Those are ancillary to how the business actually makes money. The big Pez dispenser with the cars, that doesn't make them any money. It's a marketing piece, and it doesn't drop profit. It's just something to look at. It's like brand awareness marketing. So how do we sell this idea? We just say tech, tech, tech all the time, right? We say tech, tech, tech. We say disruptive. We say scale. We say value capture. And that's how we make people believe we have something, because we've been programmed through media that think that people that speak a certain way, they use really grammatically correct English. They speak without an accent. Like I have a very thick accent. They speak without an accent. They have this very flat kind of a WASP Anglo-Saxon accent. And they use these words to make us think that there's something there that doesn't exist, because we've been programmed to mean that these words are something, right? And so that's how we sell these people on these ideas, when in reality, the business model is that we just sell loans to people using cars, right? And so then that makes people believe that we have something, you know, and so that's something that a lot of people fall victim to that I don't, because you can't come to me and say tech 30 times and say disruptive and scale and value capture and tell me that you're an angel investor and that you're a venture capitalist. None of that means anything to me, because my question is, what's the business model? How do we make money, right? Then I'm going to do a SWOT analysis of the business model so I can understand what's the strengths, weaknesses, opportunities, and threats to the business model. No matter how hard you try to sell it, none of that means anything to me, right? Let me show you another thing that's done to people. New narrative. Carvana is an extremely well-constructed pump and dump scheme. That's my narrative. I still believe that narrative, right? Carvana is an extremely well-constructed pump and dump scheme. Extremely well-constructed. Takes pros to construct this, right? The average person can never figure this out, which is why they can get caught up in it, because they can't even figure out how to construct this type of pump and dump scheme. It's beyond their ability to comprehend. Very, very well constructed. Takes professionals to do this type of job. Let me show you what I'm talking about, right? So the goal of this scheme was to be so well constructed it could fool people who are educated and certified, which then will persuade retail. So we talked about before. Am I against people being educated and certified? No, I'm not. I want you to be educated. That's what you want to do. I want you to go do it. If you want to go get a certification, I want you to go do that too. But educated and certified people get sued every day for malpractice, right? Do I want people to be licensed? Definitely. Licensed people get sued every day for malpractice. They get sued every day for negligence. They get sued every day for conflicts of interest. Happens all the time. Okay? A lot of people is in prison right now. They felt like their lawyer screwed them over. Same lawyer that passed the state bar. Happens every day. Right? But because of the way we've been socialized, if you believe that a person has certain educations and credentials, you believe that they know something that you don't have the ability to know. Not they know something that you don't know. They know something that you don't have the ability to know. That's where you start downgrading yourself. See, and once they can get you to buy into that, they got you. Not to say that you should be arrogant. I was never a fan of these guys that like to get on the internet and say they know more about law than attorneys that have studied and passed the bar. You don't know more about law than them. They have experience in the space. But you can learn what they've learned if you're just willing to put the time in. Now, you won't get the experience, but you can actually go read the same books they've read. right? But this idea that a person can't be questioned on what they're saying because they passed the test and they went to school, therefore I can't question anything about what they say, is how you get these situations like Carvana, which are designed to pull money out of the public markets as a liquidity pool. That's all this is a liquidity draw, right? That's all this is. Because the only way to make a lot of money is to hit a place where there's a large amount of liquidity. I can't get out of a deal at $30 million if I can't find a liquid enough market. So what do I got to do? I got to take this thing public. Let me go to the next slide. So we talked about before, you need a team of lawyers to do this. You probably need some really, really good CPAs, because you can't do this with run-of-the-mill people. So you got to surround yourself with professional people to structure this so you don't go to prison at the end of the day. Because when all of this is over, nobody's going to go to prison. The way they structured it out and the way they rolled it out. Nobody goes to prison when this is over with, right? Because you got to do it the right way. So the guy that did Nicola, he did it the wrong way. That's why he got a Fed case. But if you do this the right way, nobody goes to prison. So you got to get with professional people that can show you how to structure this the right way so you don't go to prison. That's why you get to educated and certified people, right? That's what they're used for. Now, what's interesting is that the educated and certified people, they're not going to make as much as the Garcias made, but they got more education than the Garcias. That's how you leverage the educated and certified people. See, people, I could give a whole class on that. You leverage their education to make you wealthy because they don't really know how to make money. They just know how to sell their services to you. The Garcias know how to make money, right? They know how to make money, right? So they leverage the education ability and the knowledge and the expertise of people that are certified and credentialed to make them billionaires. And the people that taught them how to compose it, they're not going to be billionaires when this is over. But that's a whole other conversation about leverage, right? So that's the Garcias, the son and the father. Father started Drive Time. He started Ugly Duckling, turned it into Drive Time, and then the son started Carvana. So it's a family affair. They're billionaires right now off Carvana. They was already rich or wealthy going into the deal. They're billionaires. I never got to do nothing the rest of their life. In fact, their grandkids probably never got to work, ever. Right? They just pulled this much money out of the public markets. And what they were lucky that the pandemic happened when it happened. Because it's because of the pandemic, the share price went like this. So they just got fortunate. They had the right company doing the right thing at the right time, and they were smart enough to know when to get out of the deal. They didn't try to hold on to see if it went to 1,000. When they got around 300, they started pulling all their money out. Let's go to the next slide. Now we want to talk about, again, everybody being certified and credentialed to get people to believe in that they have something that they don't have. Garcia went to Stanford, right? Mark Jenkins, CFO, went to Wharton, one of the top business schools in the country, went to Stanford. The co-founder, chief brand officer, went to Harvard. Co-founder, chief operating officer, went to Harvard. Chief product officer, went to Stanford. General counsel, went to Harvard, right? So, like I said, general counsel went to Harvard. You can't, I don't know the name of the firm is on there, but the slide is not really in high def. So they have the team put together to make you believe we got a bunch of people that know what they're talking about. This is how this works. Because I got to get you to believe in them, so then whatever comes out of our mouth, you won't question it. Well, you don't get to 08 housing crisis without people that came out of Harvard, without people that came out of Wharton, without people that came out of Stanford, but most importantly, Harvard, Wharton, most of the Ivy League schools. Why? Because the average person don't even know how to construct certain type of deals. They don't get taught it at their school. So I went to a state school. We got schools of finance there. They don't teach you how to construct deals the way they're going to teach you how to construct deals at Wharton. It's a different type of school. You'll get a good finance degree. You get a good accounting degree. But how to construct these type of deals, you got to go to an Ivy League school. So some of our biggest financial, the S&L scandal, all these scandals, if you go and research who was involved in it, it all goes back to Ivy League colleges, where they teach them how to do this type of stuff. Really, really complicated deal structure, where you can embed these things and hide these things, and at the end of the day, nobody goes to jail, right? Because it's legal, but you got to know how to compose it the right way, right? So this is how they get over your apprehension. We create a lot of positional authority. We do a lot of prestige badges because why? We got the who's of American colleges on the team. Right? My question is, what was their experience in the used car space? Outside of Garcia, who came out of Drive Time? Zero. So what do they know about used cars? But this was never a used car deal. That was never the deal. The deal was never about used cars. Because when you talk to used cars guys, who knows what school they went to? They just got experience in the used car business. But if we want to take a used car, we want to convince the public that we're going to take the used car space, which is a space that does not have any continuity. There's no company, I think, even controls over 10% of used cars inside America. Most used cars are very small, independent operators. They get their cars from auctions. They bring them back to the lot. They try to sell them. You do got the CarMaxes. You do got the Drive Times. You got the Carvanas. But Carvana tried to sell us on the fact that we're going to be able to essentially to get a large piece and control a large piece of the used car market inside the United States. But in reality, they just was a loan deal. They're just a loan furnisher. That's their real business. But if you don't look at their documentation, you won't never know that. Let's go into the next one. So Carvana provides financing on 80% of the cars it sells. It securitizes these loans to sell to keep a certain percentage on the books to create revenue stream. That's really, really important, right? So 80% of the cars that they sell, Carvana provides its own financing. So they have their own finance arm that's embedded in this particular portfolio of companies that provides the financing. They securitize those loans to sell, and they keep a certain percentage on their books to create revenue streams. So they sell certain loans, get money up front for those. The other ones they keep on their books, what does that do? Creates revenue stream. So now we still got revenue coming in because the average person that drives those cars still got to service those loans. So now when you look into the actual chat, you see links to the securitization documents, right? You see the links to that. I don't know why I keep losing the screen. You see the links to the securitization documents in the actual chat. So if you want to go look at those, go look at them. So this is all the research that I do to understand these type of deals, right? This is all I do. So while everybody's trying to find the next Instagram scammer and this, that, and the third, I could give a F. Why? Because I'm not going to get paid off that. I'm trying to figure out opportunities in the market that are going to pay me. Because if I get good enough at this, as time as I get more and more capital, I can put 50,000 in a play like this and pull 400% out. And I'm done. Y'all go do what y'all want to do. And that's the goal. Because the market produces these type of scenarios. They're never going to stop happening because the environment that we're in, it facilitates this type of situations, right? Let me go to the next one. So when you're looking at the books of Carvana, one thing you got to understand, we're looking at total shareholders equity from 2021 to 2020, right? My bad, from 2020 to 2021. How do you lose almost 100% million in stockholder equity in 10 months without an equity raise or a dividend? But on television, analysts are raising the price of Carvana, telling me they got a good business. But when I look at their documents, they're losing 100 million, almost 100 million in stockholder equity in 10 months. No equity raises and no dividends. So why are we losing equity? So then why would I buy into this deal? It's over a 10-month period. We lose almost 100 million in stockholder equity. But the narrative was that this was a great investment. Let's go to the next one. So then they wanted to acquire something called Adesa, right? And so this is where we're going to stop because I want to get into these arguments because, like I said, this is a very complicated scheme. It's not binary. It's not, if women just got married, everything in the world would be great. It's not binary like that. If, people that believe these type of binary solutions, they can't make money in these type of deals. Why? Because it still got a lot of moving pieces to it. You got to be able to think in a non-linear fashion. You got to understand there's more than one way to skin a cat in these type of deals, right? So let me show you a article. We're looking at Carvana's loan business, right? Carvana's loan business had investors impressed since August 17th, 2021. Carvana approaches loan business differently than other auto lenders, right? Carvana, unlike other auto lenders, packages its auto loans and sells them to investors. Carvana does not hold on to the debt, which enables us to see an immediate gain on the vehicles that purchase with cash. So what did I tell you before? This is a loan business. It's not a used car business. Their goal is to sell you a loan and then securitize that loan and then keep a certain percentage on the books to drive revenue. The car is just the bait to get you into the loan, right? Carvana sold more than 100,000 vehicles in the first half of the year and sold $3.1 billion in loans and securitization trusts, which is double the amount of loans that sold in 2020. Why did it do that? Because we had a lot of liquidity in the economy and the cost of cars went up. So if the cost of cars goes up, the loan goes up. Next article. Ernie Garcia, right? Ernie Garcia in April 2022 bought a lot of Carvana stock. So shares of Carvana are down more than 30% since the company reported earnings on April 20th. For the first quarter, the used car seller reported its first drop ever in quarterly sales. Carvana sold more than 100,000 cars during quarter one. Meanwhile, its net loss tallied at $260 million, up from a loss of $36 million in the prior year-to-year period. So what do we talk about? $260 million loss, up from a net loss of $36 million. And people were still giving stock upgrades to this particular company. So Ernie Garcia bought into it. According to a Form 4, Garcia purchased a whopping 5.1 million shares of the company. Garcia purchased the shares at an average price of $80. In total, the purchase amounts to $408 million. Out of the 5 million shares, 3.4 million were purchased directly by Garcia II. The remaining shares are purchased through trust in an investment firm that Garcia is affiliated with, and then you get the names of those irrevocable trusts, right? Garcia's recent purchase contracts with his massive sales last year in September 2021, he sold over $36 billion of Carvana. In the annual report, the company also stated that the interests of the Garcia parties may not in all cases be aligned with our stockholders' interest, right? So Garcia parties, which is associated with this business, they're telling you that their interests may not be aligned with shareholders' interests. Why are you buying into this particular deal? Now we're going to go back to this Adesa deal. They needed to raise capital to make this Adesa deal. So Adesa is like this used car auctioneer. They're pretty much all over the country, even though I've never seen them. But they are nationwide. They wanted to add this company in. So let me tell you a strategy that you do in business, right? What you can do in business is if you have a business that is not profitable and you don't like the revenues, but you have money in the actual company, or you can get capital, we can buy a profitable business. That profitable business now makes my balance sheet looks better because I'm able to take their profitability and merge it into my particular company, right? Adesa has a decent business. They're way better than Carvana. So that's what Carvana was looking to do, because they got to make this look good until we can 100% get out of this deal. So what do? We go now buy Adesa, but we got to figure out how to get the capital to buy Adesa, because we can't buy with cash inside the company, and we're also carrying a large amount of debt. So what do? We try to do first an equity raise or a bond raise. So here's what we talk about. Carvana revamps $3.3 billion junk bond in effort to lure buyers. Deal to fund acquisition of Adesa's used car auction business, right? So the company dropped $1 billion of preferred equity chunk and increased their debt portion by the same amount to $3.2 billion, according to a person knowledgeable of the situation. So the move was already fueling angst against the firm's existing creditors. Carvana has 5.265 notes due 2025. They're some of the worst performers on the secondary market. The new financing package could add more than $225 million in annual interest expense, doubling what it paid over the previous 12 months, according to Bloomberg Intelligence. So I want you to understand something. Carvana already was not a profitable company. I don't know where it is at in this slide. I don't have it. I thought I had the fact that over the course of their whole history, they had 1 quarter of profitability, right? Every quarter, their free cash flow was negative except 1 quarter. The issue with this Adesa acquisition was that you're already negative from an EBITDA standpoint. Earnings before income, taxes, depreciation. I forgot what the A is. You add Adesa, but you got to take on debt to add it on. The problem is that the revenues from Adesa are not going to clear the debt you got to take on to acquire it. So what do you do now? You just further increase the negative free cash flows in this particular company, right? So why would this be a good deal? It's not. I just got to keep the ball rolling a little bit more so we can get the public to think we have something to bring the stock price up, because Garcia bought in for 80. If he can get out for 100 or 120, that's a great return on his investment, and we can keep moving this money around. So you got to understand that when I see that they're doing this, why do I buy more puts? Because I know there's nothing there. There's nothing here. This company is going to go bankrupt, right? But it's not going to hurt them to go bankrupt because they've been able to pull so much money out of the capital markets during this time. It doesn't matter because they can go bankrupt. They can reorganize. They can buy the cars back for pennies on the dollar. But the actual company that services the loans is a totally separate company. That company's not going to go bankrupt. So the parent company's still going to have the revenue from the loan packages, still driving revenue into the company. So Carvana, which is part of a portfolio of companies, can go bankrupt. It doesn't matter. So they can go, they can restructure, they can go through a liquidation. It doesn't matter because it doesn't impact the other companies based on the way this particular deal has been structured out. Right? Next article. They had to go to a company like Apollo to get 1.6 billion junk bond lifeline. Why? Because they put the deal out and they couldn't get action on the deal. Did I go over this already? Yeah, my bad. I forgot about this. So following those particular changes, the deal for the bonds had to go to 10%. Eventually, they were talking about giving 11% yield. So you're a company, you issue out a bond, and investors are telling you, we want 11%. Then they had to issue other provisions in there to make sure people were confident in buying their bond. Why? Because they're taking on so much debt, and we don't believe in the future that it's very likely they have the revenues to service this particular debt. So I'm taking on so much risk, I want 11%. That's a very, very high cover bond. So this is a high yield junk bond that they're putting out just to try to generate the capital to buy Adesa. So what they did was they was able to get Apollo to give them some of the money. They was able to get some of the money from Garcia II and then other parties. But when JP Morgan put this deal out in the market, nobody bid on it. And so you got to understand is that the bond market sees straight through what they're doing. So they say, yeah, we'll take on the deal, give us 11%. And there was another provision in there that if they go bankrupt, they can't get out of the bond agreement. Right? And that's what I want you to understand. When you can look at these particular deals and understand what's actually going on, there's an opportunity for a lot of profit. But you got to program yourself to where just learning about the next scam on the internet doesn't entertain you. Let's get these slides and let's get up on out of here. Uh-oh, my bad. So we talk about the junk bond, 2.75 million 8-year junk bond to fund acquisition of Adesa's auction business. So how does this company service the past and current debt? If revenues go down because we're in a new environment, if people no longer have the money or they can't get the financing because the cost of capital starts to go up, how does the company service the past and current debt? So we already had a lot of debt from previous business obligations. Now we're adding on the Adesa debt. Where are the revenues going to come from to service all that debt? See why this is a pump and dump scheme? But it doesn't matter because the way they structured this, if Carvana goes under, it doesn't impact the rest of the businesses because they don't have everything up under one umbrella. So that's what people got to understand. Let's go to the next one. So the car selling business could go bankrupt. However, the loan business will still exist. We talked about it's going to generate revenues, and they also got the securitization. So that's pretty much what the deal is. So this is why I buy one set of puts in December, and I didn't buy enough contracts. I got almost 500% return. I thought I could get 1,000% return on this. Then I go right back in. I buy more puts in March, right, at $45. I'm sorry, at $145, right? Bought 2 contracts. Really should have bought 10. But the IV had went up, so now the contracts are way more expensive because by this time in March, the cat's already out of the bag. I'm not one of the few people that know about this deal. Now, everybody knows about it. So the market makers have adjusted it. But you know what? I said this company's going to keep falling because there's nothing there. And I still have puts on Carvana, right? I'm still sitting in puts at Carvana that don't expire to, I think, either the end of the year or the top of next year. Because I was so confident that this company's probably going to end up going to zero before it's done. Might take longer than I expect. Those puts is already in the money. But I'm waiting for a catastrophic collapse to exit out of those positions. But the way I do this is I really start to understand what's going on with these companies from a fundamental standpoint. And I don't care what the macroeconomic situation is at that time. Once I understand what's going on from a fundamental standpoint, then my question is, based on the macroeconomic situation, how long can they keep this going? There's a lot of companies that was able to survive in the market over the past 2 to 3 years because of easy money policy. They're running really, really bad businesses. As the cost of capital starts to go up, and they can't find liquidity in the market to support their endeavors, they're going to have a lot of issues, right? And they're all over the place. You just got to learn how to identify them. And they're not necessarily what everybody's talking about. When I was talking about Carvana, nobody else was talking about this company except me and some of the people that I knew that were kind of savvy to this. Nobody was talking about this company. But if we can develop people that can see these opportunities, these are big opportunities in the market. But you just got to learn how to identify it. And so that's pretty much all I want to talk about, right? What I'm trying to do is help people identify these type of opportunities and be able to take advantage of them, because one, I was in this deal early. I was in this deal in November, December of last year. That's really when I should have took my biggest position. But then once I got confirmation of where it was going, I started adding more and more to my position, right? And so one of the ways in which you can benefit is you get into these deals early. Now, the downside is that the market can be irrational longer than you can be solvent. But what helped me is that the whole market turned down early this year. So that helped push this thing down, right? That helped me. But even without that help, I would have still had the same success, in my opinion, because why? This is not a really well-run company. And people would have realized that and started putting their mother in other places. And we're seeing that with a lot of companies similar to Carvana. So that's all I want to talk about. But what I'm trying to offer you with the highest paid part-time job in the world is the education to be able to see these kind of opportunities and be able to profit from these particular scenarios, because they exist in the marketplace, but a lot of people just can't see it, right? You just can't see it. But you got to want to see it, and you got to want to take action on it, not just sit around and talk about it for 3 hours on a live stream, right? Because I don't care what these people do if I can't make money on it, because I can't stop them from doing it. It's a byproduct of the system that we live in. I would never buy into Carvana, but if retail or a fund wants to buy into it, that's their business. It don't have anything to do with me. They didn't violate any SEC rules in what they did. Like I said, everything they've done is legal. Nobody's going to go to jail behind this, right? So I'm not one of those people to where I'm going to yell scam, 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 scam. I don't have a YouTube page based around identifying scams. I have a options business based around identifying mispriced options, which these options were very mispriced, and we see that. Inefficiencies in the marketplace that I can take advantage of and I can locate those using a fundamental analysis, and then I can exploit these things, because by the time everybody figures out what's going on, I already got my position in the market. And that's what I'm trying to get people to understand. So we're going to go through the questions. We're going to get up on out of here because I got another live stream in like 10, 15 minutes. So like I said, here's the documents. Here's the securitization documents. Right? Mr. Rose, what's going on? What's going on, Lance? So local governments collecting more tax on personal property, especially with cars due to supply and chain issues. I feel you. So local governments are collecting more tax on personal property, specifically with cars for supply and chain issues. That's crazy. Lance, what's going on? Glad you came through. Yeah, it was Bernie Madoff. I keep forgetting his name. Yeah, definitely, GC. They're going to accept. And that's just part of how it goes. Like, I see why people go get that stuff, because you can walk in the door and say, I'm so-and-so and so-and-so, and I got so-and-so and so-and-so, and people just believe you. Right? Just believe whatever comes out of your mouth. So I see why people do it. And I'm not against people doing it. I mean, if that's how, if it works that way, it works that way. Yeah, definitely. Investors. And one of the reasons, in my opinion, GC, is because people want abnormal returns. Right? So the Coca-Colas, the Pepsi-Colas, the waste management companies, a lot of the construction companies, 6 and 7% returns annual. People want a greater return than that. So they now look for those returns, but they look for them at companies that are not really sound. They're very exploratory. Can they generate those returns? Yes, but the problem with those type of companies is they're only attractive in an easy money policy environment. We're no longer in an easy money policy environment, so we see all the money get sucked out of those companies, right? And a lot of people now, they don't have a leg to stand on as fund managers. Why? Because they built their whole portfolio based around those particular type of companies instead of just investing in the Coca-Colas and the PepsiCo's, and the waste managers and getting that 6% every year. So a lot of this was going in the cryptocurrency space. A lot of people get caught in pump and dump scheme. Yeah, definitely. You're going to see a lot of crypto. And also with those, I told people 3 years ago, I said, man, they're going to pump these exchanges up and they're going to rob their own exchange. I was telling people that years ago. I know what time it is. And we saw they did a lot of that too. I was watching a documentary about a guy that had an exchange. It was like 200 million in the exchange. And they claimed he went to India and passed away. And people put their whole life savings in Bitcoin and put it in his exchange and could never get their money out. Why? Because liquidity wasn't there. Right? So they claim he passed away, but some people claim he just took the money. Exactly. So people salty about Adam Newman raising all that money, but dudes know how to persuade people into buying the higher valuations. Exactly. And a lot of it is modeling. A lot of it is access. A lot of it is networks. He knows the right people to get money from. And as long as he knows the right people to get money from and they still believe in what he says, he's going to continue to attract capital. Right? And it just is what it is. You know, it is what it is. There's nothing you can do about it. And you're right. Those higher valuations make early VCs ridiculous amounts of money. You're 100% correct. Yeah, definitely. They just they figure out how to build a team with a bunch of people. You know, with so and so and so and so, he worked for Amazon. Or so and so and so and so, he worked for this company. What people don't know is that when you're working for those companies, it's very competitive. You're not working for those companies because you weren't winning at those companies. So I don't leave Amazon and go work for a startup because I was winning at Amazon. I leave Amazon and go work for a startup because I wasn't happy at Amazon or I wasn't winning, because those are very competitive environments. So they do the same thing. They build their team up with a bunch of people that washed out at other companies, but it makes investors believe we got a good team because they worked here, 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 and here. It is what it is. It's all about perception. Perception is so powerful in this world. I think a lot of people overlook it. Definitely. You just raise that, acquire profitable because it's the easiest way to do it. You can leverage the profitable, easiest way to do it. And that's what you see. That's what Uber was trying to do. Is they were using their capital to acquire other companies because they weren't profitable. And they're trying to figure out how to acquire something that is profitable to make their balance sheet look better. It's the oldest trick in the book. It's just a balance sheet trick. But the issue is the core business isn't profitable. Right? But people don't see that. And if all you're going to do is acquire companies, why don't you just do private equity? Like, I don't invest in, because to me, that's not a strategic acquisition. So if I'm going to acquire, let's say Lance got a company. So Lance is really, she's an expert at TA, right? So say I put a deal on the table. I say, Lance, look here. I'll buy your company out at 50%. Or let's say I'll buy your company out at 45%. You still keep the other percentage, so you still got majority. And I give you this many millions in cash. And then I'll just embed you into my service pie. That gives me a strategic advantage because now I'm embedding somebody into my service pie that's an expert in technical analysis. So they added more value to my situation, right? But it's a strategic move. It's not a move to where my company is negative free cash flow. I buy Lance's company who's positive free cash flow, but I'm still telling people to invest in my company. But my company's still going to drag the overall company down because I still got a negative free cash flow company. That's what they do. So that's why I don't understand why I would invest in that. But if you don't see it, then you just don't see it. So I'm not against a strategic acquisition that adds more to our service pie, but I'm not a fan of I'm just acquiring something just because I'm trying to make my balance sheet look better, because my attitude is that if y'all want to do private equity, just do private equity. Why try to run a service-based company or a product-based company? If you want to just do private equity moves, just do private equity. Just get you a pool of capital, go buy companies, turn them around and sell them, or break them down into pieces and sell them. So I don't like my publicly owned companies operating like private equity, which is what a lot of these companies do. But people go for it, so it's all good. Yeah, definitely. It's about getting that return for early investors, which I get. You know, if I've been in the deal 8 or 9 years, I want to get out. I don't want to keep holding this money because I want to get out with my return and go put my money into something else. Ray Gunn, I appreciate the $2, man. Yeah, definitely. Yeah, pump and dumps have gone way beyond these pink sheets. Definitely. You've seen them in big companies now, like Carvana. Who would have thought that a pump and dump company would get to $300 or $350? You know, it's amazing. But that's the world we live in now. You know, it used to be that the pump and dumps was those, you know, fly-by-night pharmaceutical companies and fly-by-night tech companies, you know, that don't even have a real value proposition. They get to like $5, you know. But yeah, we passed those days now. You know, GameStop's a pump and dump deal. And we see they keep losing money. You know, they were a pump and dump deal. So average person can't tell you the last time they even went into a GameStop. So how can I schedule a consulting service? First, what do you want to get consulted on? 2, I can't teach you everything I know in an hour. So I want to make sure we manage expectations properly. And 3, just hit me up on Instagram. Yeah, definitely. Yeah, definitely. So the trade takes all of 5 minutes. But the majority of the work, I did the majority of this work in 2021, leading up to this time. And I was positioned to do it, but I wish I had more capital because I would have put way more money. You could have never convinced me that Carvana wasn't going down. It was $350. You got to be crazy. I knew why Avis was able to stay up, because what they were doing was they was shrinking their float with buybacks. They bought back over 1 billion shares. That's how they was able to manipulate that situation. They're going down too, right? But Carvana wasn't doing any of that, right? They weren't doing any of those methods to keep that share price up, because they should have shrunk the float. That could have maybe kept them up there. They don't care. They don't care. They're out. They're out of that deal. So it says, I bet you can go on volume analysis and see institutions distributing on Carvana before that panic selling set in. Probably could, you know, because they know. But if we were to look at the analysts, the price targets they were getting for Carvana, I'd say no way in the world that's going to stand up to the test of time. All right, so that's everybody. I appreciate everybody for coming through. This show is sponsored by the highest paid part-time job in the World Options Training Academy. Get in before the price goes up. But this is the kind of work that we're trying to do in this space. I got people that took my program that do day trades. I'm not against it. I'm all about you making money how you want to make your money. But this is really what I do, right? I'm still spoon-feeding myself on intraday trades. But what I really am good at is long-term deep analysis of a company to make long-term swing and leap plays. Doesn't mean you need a lot of money to make money to be able to trade in this market, because I didn't start off this way. But this is what I got. So I can show you how to trade on a smaller price point, because that's how I started. But the analysis is the same whether you're trading with $40, you're trading with $400,000. You shouldn't skimp on your analysis, in my opinion. And when I do the most amount of analysis on a trade is where I have the most amount of success. When I do the least amount of analysis is where I always take the most amount of losses. And it's been pretty much consistent over my trading period. So that's all I want to talk about. If you got any questions, reach out to me. David W. Williams, also known as Diamond Dave. I will talk to you later.